Good morning, mates, on a Sunday. And what do we have before us on this Sunday? Remember, it's still the month of January. I got a January call, 2:15 call on BIDU. And basically, what the new training with a lot of people is that on this specific date, they were all in, and that call was $17.91 on January 8, 215. We turned that the call was all in and that the put chart was at its high, and there was going to be a change between the bid and ask with the floor traders, floor specialists, even the floor traders on the CBOE were also doing their thing when all of this was taking place. And so the put options were at its all-time high. And basically, I'm going to do the following, is as we start talking, I would recommend one thing for yourself. And my recommendation is that we are using a very sophisticated trading app that tells us exactly when they're all in. And over here in our big platform on they were all in at 232, and the real move in the call side started right here on January 5 on calendar date is January 2015. And this trade is in the second trading day of the year, of our new year. We're still in January. They were buying the calls. And from 219, we popped up on a gap. 227 was a high, and we go back to this was the once again, this is where the calls were at their very lowest, and they bought them, and we went from 216.02 to 220, and then, my friends, from 222 was still a narrow range gap, and we go all the way up here. It was a flat day. You had a $5 move or so. You ended up making this high, I mean the low on 221, and then we actually close it out on the closing bell at 214. Now we're going to focus on the 18th of January on BIDU. 227 was a high of the gap open, from the gap open. The actual intraday high was 232. And so the calls were still working. And the bear side, or the put side of the market, was buying every one of these top end, and they got the top end at 232. It drops to 224. That was a short from here to here, and then once again on January 8th, we pop off of that low to 229 on the closing bell. From that point on, we went to the 230. We make another high on January 9th. The call side of the market from the 224 low, they were really good on the call side, and they were really fantastic right here on the call. And if you didn't sell the call and buy the put option on this very date, and we're talking with January 9th. Now, I'm going to go into the other system, and you're going to be able to see beyond a reasonable doubt where that particular market move is. I would also like to say that this is the tree for January in BIDU, and this was a 215 call that we bought. The trade volume on that day was 2.8 million. The trading volume right here, though, is where they're buying into everything, makes the low at 215 right here. This is where the put side of the market was making money. It cost you 15 cents. I said 15 cents. And I'm not joking about the 15 cents. On the 215 put, we were at the all-time low. And right here on the high, we were 16.25, and we're 15 cents. Now, why do we buy them at 15 cents? I will tell you why. because that's the lowest price for these 2 days right here that I showed you in the platform and whatnot. This was the bid and the ask. The previous day, they were 20.25 by 21.45. And it's all based on that particular data field. Now we're looking at only a monthly. And I'm going to go back through here, and I'm going to go back to why you made money on the call, but you bought here on the puts at this cheap price. And nobody can do that. We do it very well, but we have built a system that tells us when either side is all in or out. And we are happy to tell you right now, here's what we're talking about. So I'm going to share this with you. I'm going to take the video for now, and we're going to use this for a training video for the rest of the year. End of the story. Here, the calls were all in. But you got to remember that the put options were being bought when these were at the high. The put side was screaming on January 8th. And we can clearly see that when we go back to January 8th, this is it. I said that was it. And not only did I say it, we can prove it. This is the 215 call. Right here. I will pump this up here. I will go to here. I said we would go here. I'm just pumping that up. I wanted to see something. So here's what we're going to do. We're going to pull that high. That was this right here. So you understand. Now we're going to go back to one thing. We're going to go back over to here. We were right here. We had already worked that off because the put side bought up here and the call side was going down, down, and down in value. We made a big put option entry from here to here, and that was January 8th. Then when you opened up over the weekend, the put side was still working at 220 on the low, and it closes on the low. And then we went through a sideways channel on January 13th and January 14th. On January 15th, from that trade on the put side, I will go to show you right now what that means again. So, the call side was losing value, and the put side continued to bring, under the high columns here, we're making their money. But here's where the change was. We went from an exuberant high to an exuberant daily low. This is a January 15, 2000 call. I guarantee you that 99.99% have never, ever read a call or put chart. They have not. However, we do. And our entry right here was at 5. Okay, so we'll go with the low of 565. That's this low. And it went up to 670 on the close. Right here. Right here. That's the low, 2-day low. And as you were buying the calls, of course you were going up to 845 and you were making money. Now, one thing about this system is you could still been buying down here and adding to the position. Adding the contracts to the position. Getting ready to go net long on BIDU off of the bottom was doing that. And that was right here. And yes, every one of these wicks were giving you a chance to get in before in 3 days we skyrocketed. And that was the monthly option expiration. And look at the values. They're right back up here. Yeah, they are. And look at the value here. Look at the value right here. Here, watch. That date, 123 is the day that they close out on those. And so that's what you're going to want to see right here. Bingo. The put side of the market was going down. And there was not, so the put side of the market kept going down when we were at the high over here. And on January 15th, here in our system, it was still going flat again at the 215, and then it pops up. You're buying the calls here, and then the shorts are still working a little bit, but the short was at its high. The put option was at a high. And now the put options are working, and on this very date, January 15th, that was the beginning range of buying these calls. And it was. So on January 15th, we were the 14th buying. We were 115 buying on the call chart. And we were still buying because the low was 650. And then we were buying and the close was 745. And we had a skyrocket in flight with a very good afternoon delight. And what was that? That was the value of their call and put markets that were working. And so the calls and the puts are out right here. The calls are in. And right now on this date, I'm going to show you the high because we went from $9 to $16 and they gapped that up. And this whole move was based on the weekly options expiration on Friday. That's where they made their transformation on a weekly contract that people say, oh, I don't even know it. Well, of course you don't know it. They write those contracts on Thursday and the rest of the world don't know it. They don't know it, but here's what we know for damn sure. Remember, the math and mechanics of a high-frequency program that we have developed is always going to show you why that you did not buy at the 214. The puts were all in. The calls were right here. And they were. And a daily chart right here is these bottoms. That's a 1 day. That's a 2 day. We're starting to go up on the third. The fourth day up. But we started on the wicks down in this call contract, and we would continue to add on that, add into it, and then guess what? On the date up here, on January 16th, these were the 13th, the 14th, the 15th, and the 16th, and we finally hit the 16th. But here, let us not forget that the calls are working, and on the 15th, they were at their premium high right there. Okay, and then here we're back again at the low of the volatility in the option bid. So I can clearly tell you that on that 3 day move we hit 230, and this is the last trading day, and we've been buying calls all week and then selling them. And on the January 215, the 22nd, we made another all-time high. And guess what? On this one particular contract, and I will go out to other dates, but we did make the high. And we did. For the put side of the market, the 215s, check it out. This is the put. You want to see something good about being a market maker in options? This is why. This is why. From 15 cents to a 15 cents, that's when the puts were bottomed, vice versa. Over here, you can see what happened to the people that had the calls. They went straight down, and guess what? I got to buy it, and we did. We rolled it over, of course, for this coming week. And once again, it's about the mathematical imbalances, because this particular option is a great trade. And I am telling everybody that the calls right here were inflated. They were. Look at where the calls got. I'm just visiting this again. Look at, and look at where the puts were. Ooh. Ooh. Say Rockefeller at its best. Right here, an all-time low. A high-frequency algorithmic model that is used in the intraday processes in the equity side, that's the stock side, is the one that is going to be use to gauge your entries between inflated and deflated values on BIDU. And this same rule applies everywhere. You had a chance to buy them at 15 cents. And in our option market makers, which you will go into that program, this is going to help you get the entries that you knew damn well that you would have never gotten your whole life. And I'm not joking. So if you want to get busy, you want to get in, this is what you're going to get. And say, wow, wow. How did the call side go from $5 to 15 cents as the public rode them down? As what the public will do beyond a reasonable doubt in their world. Let us not forget to let you know that our mathematical value and options are traded, and on the 22nd, the puts were after their all-time high. Calls once again made a high, and then the lows, and this is where you can learn how to buy options at 15 cents and make a lot of money. And that's a very intraday low. The people that were in here, they got walked down. Look at that, $5 to 15 cents. I think our 15 cent is a much better entry than what the public was doing. See, every time they get a game, then they write it down to nothing. End of the story, end of the video. Sign up today. Do yourself a big favor. A big favor. Get in the market maker division on the equity, from the equity side to the put side, call side. Take responsibility. Go for protecting you.